There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone, today I want to talk about the popular stock indicators, MACD, Stochastics, RSI, Bollinger Bands, those kinds of indicators. Every indicator was written in a certain time or era by the indicator writer for a specific purpose. When you're evaluating indicators to determine if they will be useful to you, and it should not be based on their popularity, it should be based on your trading style, your risk tolerance, the type of style trading you want to do, whether it's swing day, intraday, position trading, or whatever. You have to choose the correct indicators. But you also have to ask if the indicator has all of the data that you need to do a full and complete analysis. Now, I want to talk about this because you need to understand the history of stock indicators. I can already hear the groans because most people hate history because it wasn't taught in an exciting manner when they were in high school or college. Actually, the history of the stock market is very exciting and very interesting and full of information you need to understand so that the decisions you make about every aspect of your trading process, from selecting the stock chart type, like candlesticks or bar charts or line charts, to the indicators you use, such as MACD, Stochastics, Bollinger Bands, RSI, and others, to how you approach your trading, how long you hold the stock, how much risk you take, what candlestick patterns are going to work for you or whatever buy entry signals you use, and what your intent of your trade is, your capital base that you have to trade, and so on and so forth. When you're building a trading process, and that's what I teach, I don't teach strategies because there are tons out there, and all you have to do is get your trading process correct, and then you can select the strategies that work best for that. What I teach is a complete trading process, and part of that process is selecting the right indicators rather than just using the indicators that everybody else is using. There are problems with overly popular indicators that I will talk about in a few minutes. To fully understand an indicator, there are 10 different things that you need to know about that indicator and what it will do. You need to understand who wrote the indicator and the intent of that indicator. What was the indicator writer trying to do? You need to know what data is included in that indicator and whether it was originally designed for long-term or short-term trading. Some indicators are definitely simply long-term analysis no matter how you adjust their settings. You need to know also what time period it was written in. That tells you what market condition was present at that time, and that's very important. Was it a momentum market? Was it a trading range market? Was it a bottoming market? It makes a difference because the intent of the writer was to find good stocks for either long-term or short-term based on the market conditions he was seeing at that time. You also have to understand what category it falls into. Is it a quality indicator, analyzing the quality of the trend and price action? Is it a quantity indicator, indicating the large lot versus small lots? Which side are the large lots on because they dominate price when they're in there? Is it an oscillator that oscillates? Now there's price oscillators and there are volume oscillators. Most of you don't use volume oscillators and you should be. Is it the flow of funds in and out? Because that isn't directly correlating to price. A lot of you use the very simplistic approach of supply and demand, thinking that's all you need to understand how price is going to move next. And that is not the main thing anymore because our market is so constructed so differently. You need to understand what it is designed best for. Swing trading, long-term investing, what is it designed best for and what to use? What are the strengths of that indicator? What should you use it best for? And what are the weaknesses? What are the things that it won't be giving you a correct confirmation? How does it work with the candlestick buy entry signals or other other signals that you're using? Because price is an indicator. It is part of the whole thing, although we separate it out. Price and volume are indicators. They indicate a great deal. Does it use moving averages to smooth out price or volume patterns? Or does it use other indicators to give you the lines or the bars that you need to understand what is going on with the stock? It's very important to know that. You need to know which of the 6 market conditions that indicator works ideally in and which of the 6 market conditions it doesn't work well in. As an example, Robert Colby did a 20 or 40-year exam of MACD and determined that it doesn't do well for selling short because it was designed primarily for a momentum buy-side uptrending market. So if you're trying to use MACD when we have a downtrend and in a sell short, it's going to fail you more often than not. So those are things that you need to know and understand, and there's many different aspects of understanding how the stock is going to work and how the indicator is going to work with the stock price and volume. Now, no matter how you trade, you have to have the 3 components of data that are available that comes from the market. There are others, but you have to have these. Price, the open, high, low, and close for the day. The volume, the total quantity of shares that were transacted, that traded hands, that's one side of the trade, not both. It's the transfers that's counted, not the dual buy and sell. It's just one side. That is applied to either the upside or the downside with a green bar for the up or down. It's applied to the whole of it based on where the price ends. If the price ends lower than the day before, the volume is red. If the price moves higher, all the volume is applied to the green side or upside. So that is how you have to look at volume. It doesn't disseminate between whether there were large lots, 100,000, 500 share lots, selling off or buying versus the small lots, buying or selling in opposition. Because you'll pretty much find, except on rare momentum velocity moves, that there is a constant contrarian factor in every trade where the large lots are on the opposite side of the trade of the smaller lots. Now, that is a very specific indicator, and there are only a few that have been created to date. If you understand MACD, you can use it in certain instances, but the problem with MACD, Stochastics, RSI, and Bollinger Bands is they're strictly price and time and have no volume or large lot versus small lot in the indicator formula. Now, you can add some of those as a subordinate indicator or a primary against a primary indicator, but it is better to add an indicator that was specifically designed to disseminate between large lot and small lot activity. So, MACD was designed in the 60s during a strongly uptrending market, an expanding market. It was growing exponentially. A lot of stocks were coming out of bottoms at the time that Gerald Apple made that indicator. Now, he wrote it as a momentum indicator. He wanted to see that there was a crossover from the slower to the faster moving averages that he combined. There would be a convergence or divergence on the 2 lines combined because one is shorter and one is longer. Therefore, if you shorten both, you eliminate the whole idea or concept of what he was trying to do. A lot of you try to use it for really short-term trading, and MACD was designed for long-term investing. Now, it does tighten up pretty decently, and you do need to use exponential, but still, it is not a complete confirmation that the stock is going to continue moving up. It also has a tendency, because it is based solely on moving averages, to be a delayed trigger. In other words, price has to move up before MACD signals an entry. That means in tighter activity markets where there are fewer runs that are really long and you don't have to worry about that big white candle that you've lost all that money on because you're getting in late, you can ride it up. But on choppy trading range, sideways markets, platform markets, that extra day of profits, of lost points, is a big deal. And in certain market conditions, like we have right now, where there's huge indecision and turmoil, the stock can move up slightly and then whipsaw on you. MACD doesn't have any way of telling you if these things are going to happen. So you may be going along using MACD and it's just absolutely fabulous and you're having a good time, and then all of a sudden it stops working for you. One of several things have happened. First of all, market conditions have probably changed. Second of all, it may be signaling way later than it should be based on how price is moving. And third, price may be moving up speculatively with no volume behind it, meaning the large lots are not buying it, so it whipsaws. So there's a variety of reasons why MACD can fail when it was doing so great before that. Those are all the things you need to learn if you're going to be successful trading with MACD. And a lot of times, all you get is some real basics, and then you think, oh boy, this literally works because everybody's showing you all the great and wonderfuls and they're not showing you the problems with it. The other issue with MACD is the HFTs use it in their algorithms to find stocks that are poised to cross and that have moved up that retail traders are going to find inviting and all going to buy all at once. Since the retail crowd tends to trade as a group, a big, huge group, they have anomalies in order flow and they have cluster orders on one side or the other. And HFTs just go, okay, we can front run this. They jump in ahead of everybody and then they start selling as all your retail broker orders are filled later. They're on the millisecond scale. Now I know your broker can fill very quickly, but even delaying a few milliseconds can cause a huge difference in your entry point. We're on a penny, half penny market now, and it matters. Stochastics was written in the 50s during a trading range market. We were coming out of the World War II situation, and a lot of people weren't sure about stocks. Mutual funds were just being approved. They had been banned and outlawed for 20 years, and they were just beginning to come back into the market. And so the market was in a trading range, and a lot of companies were trying to get themselves resettled after the war. George Lane could see that there was opportunities for short-term trading if he could design an indicator based on price, because then he could see the crossover at the top bar as indicating overbought, or down on his lower line as oversold. And he thought that this would be a great way to trade, and it was in the 50s. Now, both Lane and Apple had a problem that we no longer have today, and that is it was very, very, very hard to get volume data from the market and impossible to get large lot versus small lot data from the market. It was simply unreliable. Nobody had it. So charts didn't have it. All they had was price action. So their data that they were using, and both of them use moving averages in very different ways, were based on price and time, and that's all they had. They couldn't use a volume. They couldn't add that because it wasn't available at that time. So they were basing it solely on that, which was a huge disability for those indicators that you use nowadays, because a lot of times that fact that that piece of data isn't in those formulas can cause a lot of problems with trades. You may be going along really well with one of those indicators and then all of a sudden, whack, you got them really bad because volume patterns and large lot versus small lot is not indicated in those indicators. You can't read that kind of stuff in there. So you're missing that information, and that's what causes a lot of your losses. It's very simple and straightforward. There's no market maker, evil guy trying to rip you off. It's that you're not having the full set of information that you need. So this is very detrimental to you. RSI, Relative Strength Index, which is not named properly, is another oscillator, price oscillator, written by Wells Wilder. But that one has where he was comparing recent price action to X number of days ago, which is a much better oscillator in certain instances. Not that it's better than stochastics all the time, but it has its place and purpose. And by adding a primary volume indicator with that, that compares volume against volume over time as RSI compares price over time, you have a fantastic combination leading indicator, and that's one of the indicators that I have created myself for my students. I don't offer it out as a public domain because people have to understand how to use it, and I don't want to be famous. I just want my students to be successful and have financial security. I don't care to be a big name brand out there. That's not my purpose. You also have Bollinger Bands, which I also teach and are simply fantastic. But again, the best way to use Bollinger Bands is to also use some of his variations that he's created, %B, bandwidth, and others to help you, and also add large lot versus small lot indicators. Then you have a complete set of data to analyze and know what's going to happen. Because just because the Bollinger Bands compress, you still don't know whether it's going to go up or down. And the volume indicators will give you that information. So by combining different indicators and using them differently than what you're taught on the internet everywhere will help you improve your trading. Most of you who have been trading 2 to 5 or longer years need some help with filling some of the holes that you have in your education. You make a little money and then you lose a bunch of money. Then you make a little money and you lose a little bit of money. And so then you become kind of obsessive compulsive. You think, I can do this if you could just figure it out. And it's just little things, little tiny details that you don't understand. It's little holes in your education that need to be filled that you don't have the bigger picture on, and you don't have a complete trading process. You're trying to use a trading strategy with a certain indicator, and it works some of the time, and then the rest of the time it doesn't work, and you have no idea why. You think it's maybe market makers or somebody else trying to do damage to you deliberately. And I have to remind you that the market is fully automated now. Even your orders are automated through your retail brokers because they are considered a consortium dark pool by the SEC. So you're trading in your own little retail side dark pool, but it's lit so everybody else can see it. So then, yes, if there's cluster orders and large groups of traders on the retail side all trading the same stock at the same price, some of the predatory systems and some of the opportunists are going to take advantage of you. Sure, they're going to. And you have to be aware of that. You have to understand that. So what I'm trying to say to you is you probably have a good start to your education. But if you're not having an 80% or greater success rate after 5 years, there is a massive problem with your education. And you will continue to have these problems until you fix those areas and learn what you need to know, develop a full trading process that's like a professional, learn the professional types of order processing that eliminates the risk of your retail broker, get onto a more sophisticated platform, and really start to trade for financial success. At the end of the year, you should be very proud that your trading business made money. So stop and learn more about stock indicators, how they work, understand what's going on behind the scenes, and not just watch a MACD webinar from somebody that says, you make lots of money with MACD. So there are 10 things you need to know about any indicator before you ever start using it. I'm Martha Stokes, and that's our radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.